At Numerian Capital, we bring you the latest stock news each day. Please like and subscribe so we can bring these articles to you each day. Thank you.
Today, September 14, 2022, Vicor Corporation's stock has shown weakness lately, but financial prospects look decent. Is the market wrong? With its stock down 15% over the past month, it is easy to disregard Vicor, Nasdaq VICR. But if you pay close attention, you might find that its key financial indicators look quite decent, which could mean that the stock could potentially rise in the long term given how markets usually reward more resilient long-term fundamentals. Particularly, we will be paying attention to Vicor's return on equity today. Return on equity or ROE is an important factor to be considered by a shareholder because it tells them how effectively their capital is being reinvested. Put another way, it reveals the company's success at turning shareholder investments into profits. How do you calculate return on equity? The formula for return on equity is return on equity equals net profit from continuing operations divided by shareholders' equity. So, based on the above formula, the return on equity for Vicor is 8.5% equals $38 million divided by $445 million, based on the trailing 12 months to June 2022. The return refers to a company's earnings over the last year. So, this means that for every $1 of its shareholders' investments, the company generates a profit of 8 cents. What has return on equity got to do with earnings growth? We have already established that return on equity serves as an efficient profit-generating gauge for a company's future earnings. Based on how much of its profits the company chooses to reinvest or retain, we are then able to evaluate a company's future ability to generate profits. Assuming all else is equal, companies that have both a higher return on equity and higher profit retention are usually the ones that have a higher growth rate when compared to companies that don't have the same features. Vicor's earnings growth and 8.5% return on equity. On the face of it, Vicor's ROE is not much to talk about. We then compared the company's return on equity to the broader industry and were disappointed to see that the ROE is lower than the industry average of 12%. Despite this, surprisingly, Vicor saw an exceptional 38% net income growth over the past 5 years. Therefore, there could be other reasons behind this growth. For example, it is possible that the company's management has made some good strategic decisions, or that the company has a low payout ratio. As a next step, we compared Vicor's net income growth with the industry, and pleasingly, we found that the growth seen by the company is higher than the average industry growth of 9.4%. The basis for attaching value to a company is, to a great extent, tied to its earnings growth. What investors need to determine next is if the expected earnings growth, or the lack of it, is already built into the share price. Doing so will help them establish if the stock's future looks promising or ominous. If you're wondering about Vicor's valuation, check out this gauge of its price-to-earnings ratio, as compared to its industry. Is Vicor making efficient use of its profits? Vicor doesn't pay any dividend currently, which essentially means that it has been reinvesting all of its profits into the business. This definitely contributes to the high earnings growth number that we discussed above. Summary. Overall, we feel that Vicor certainly does have some positive factors to consider. Despite its low rate of return, the fact that the company reinvests a very high portion of its profits into its business, no doubt contributed to its high earnings growth. Having said that, looking at the current analyst estimates, we found that the company's earnings are expected to gain momentum. To know more about the latest analyst predictions for the company, check out this visualization of analyst forecasts for the company.
Thanks for watching Numerian Capital News. Please come back tomorrow for another stock news update. Thank you.